Today we're going to continue with where we left off last week. Continuing with the fixed income instrument features. Last week, remember, I said that I'm going to give some bond examples.
Yep.
We'll look into some real life examples of bonds. Before that, we need to just clarify some terms. One of the terms that we are clarifying is the CUSIP. CUSIP stands for Committee on Uniform Securities Identification Procedures. So there are two ways for you to differentiate between bonds. So one of them is CUSIP and another one is ISIN. So both of them are identifier. The CUSIP system is used primarily in the United States and Canada to uniquely identify securities. CUSIP number is 9 characters long. The first 6 characters represent the issuer, known as the CUSIP issuer number. Then the next 2 characters represents the specific issue, known as the issue number. And the last character is just a check digit used to validate the CUSIP. So the other one will be the ISIN. ISIN stands for International Securities Identification Number. The ISIN system is an international standard for identifying securities used globally. As you can see, the difference between ISIN and CUSIP is just used for North America. And ISIN number is 12 characters long. I think CUSIP is 9. Yeah. And the first 2 characters represent the country of the issuer. And the next 9 characters are the national security identifier, which can be a CUSIP or other local identifier. This next 9 characters, it could be CUSIP, it could be some other identifier. And the last character is similarly used as a check digit used to validate the ISIN. Okay, and one last thing term we need to talk about is the seniority. So I believe last week we talked about seniority, but I didn't actually go into details like what are the different categories. So it's, in terms of the ranking from the most senior to least senior. So the most senior will be the senior secured bonds. The characteristic for these bonds are that they are backed by specific collateral, such as real estate equipment or other assets. And in terms of priority, in the event of bankruptcy, holders of senior secured bonds have the first claim on the pledged collateral. So, Kenneth, you know what is collateral, right?
Yes. It's something that in case I default, I can just take that back.
In terms of the real estate, automatically your property will serve as a collateral, right? And in terms of bonds, a lot of times, it's not necessarily you have to have collateral, because collateral are expensive, right?
Mm-hmm.
In the sense that the cash, especially if it's like a treasury bonds as a collateral, because those are considered risk-free. Rather than using that for other purposes, you have to keep it as collateral. The next in line will be unsecured bonds, which means that they are not backed by any specific collateral,
Mm-hmm.
but are backed by the issuer's general creditworthiness. The higher the seniority, the lesser will be the coupon rate that you get from the bonds. So for senior unsecured bonds, these are unsecured. And we have the senior subordinated bonds. So these bonds are also unsecured, but they are subordinated with senior unsecured bonds. So they have a lower priority than senior unsecured bonds, but are still considered senior to some other forms of debt. The junior subordinated bonds, so these are pretty much in terms of plain vanilla bonds, are the most junior. So they are known as subordinated or subordinated debentures. These bonds rank lower in priority compared to all senior classes of debt. And these are only paid after all the senior bonds have been satisfied. And lastly, we have convertible bonds. So convertible bonds are bonds that can be converted to equity. As convertible bonds, they can be either senior or subordinated, but their priority depends on their specific terms. Generally, they rank as senior unsecured debt unless specified otherwise. Okay, now that we have gone through these terms, we can look into actual examples. This is an Apple corporate bond. From the title, you can see that AAPL, this is the ticker for Apple stock. And 1.65% just means that this is the fixed coupon rate. And 11th of May 2030 just means that this is the maturity. And it is denominated in US dollar. So this is a corporate bond. The issuer is Apple Incorporated. And an announcement date. So this is the date that they announced they're going to issue this bond. It's May the 4th, 2020. The date that they issue the bond is 11th of May, which is a few days after the announcement date. And as you can see, the maturity date is 11th of May, 2030. So from this, we can easily see that this is a 10-year bond. And this is the years to maturity. Wait, this is oh, you know why? Okay, because, we can see that this is a 10-year bond, but this years to maturity is only like 6 years-ish. You might wonder, why is that the case? Like, why is a 10-year bond has a 6 years to maturity? I believe this bond could already be called, or this could be the estimated years to maturity. So this is a callable bond. There is a call option tied to this bond. We'll see that later at the bottom. But for now, we just see that there's a 5.9-year estimated years to maturity. The next call just means that this bond can be called in about 5.7 years' time. And the bond is issued at a price that is below par. So do you remember that I said that the par price is 100? Right? So the bond price can be below or above par price. So normally when you issue a bond, the price will always be 100. In this case, the bond price is slightly lower than 100, which means that when this bond was issued, the market rate is higher than a coupon rate. That means for a similar issuer with all the same terms, you can get a higher coupon rate, as in a higher interest rate in the market. But this rate, when they announce it and from the day they issue, the interest rate has risen a little bit. So in order for this to be fairly priced, so they discount it a little bit. So you're paying a cheaper price, a discounted price, because your interest rate that you get from this bond is actually slightly lower than the market rate. Because the interest rate in the market changes all the time. So there's a reason why there's a discrepancy. If the interest rate in the market is exactly the same as the fixed interest rate, this will be priced at par, which is 100. Oh, you can see this here as well. You see the 1.727. This is the yield. So this is like you can think of it as a market yield. So the market interest rate is 1.7, but right now I'm only paying 1.65. So in order to compensate the difference, this bond is priced at the discount rate. The coupon type is fixed. So this is a fixed coupon rate. So this one is fixed 1.65%. Coupon frequency semi-annually just means that the coupon will be paid out every 6 months. And so this is the reason why I was talking about the seniority, because this is classified as a senior unsecured bond. For the reference rate, this is not valid because this is a fixed coupon. If this is a floating rate coupon, they will have a reference rate. So you have a margin on top of the reference rate. But in this case, this is fixed, so this is not valid. And we have the ISIN number. So remember, the first 2 characters is the country code. And we have the next 9 characters, which in this case is exactly the same as the QC number identifier. Because you can imagine that bonds are different from stocks. Right? Stocks are fungible. So any shares in the Apple stocks are the same as any other shares. There's really no need to identify the shares. But for bonds, different bonds with different terms are different, right? So the only way you can identify it is from the ISIN or the QC, which is the reason why this is important. Because, for example, if I want to search for this particular bond, I had to search using this identifier. And the bond currency is USD. So this is the total issue size. For this whole bond, Apple is borrowing $1.75 billion. Last week, I was saying that you need to, there's a high nominal quantity. But when I search for these bonds, turns out that you can actually buy it minimal 2,000 USD. You can buy this particular bond. And every incrementer is 1,000. So you can buy 3,000, 4,000, 5,000. But I'm not exactly sure, whether this will affect the bid-ask spread. I would reckon that probably higher quantity will have a tighter spread. But in total, this bond is 1.75 billion, and they can split it into smaller nominal quantities for people to buy. So this is a corporate bond type. So this is a AA plus bond rating, which means that this is a high graded bond. And on the top, it's showing you the current bond price. So this is the issued price when the issue is 99, but this is the current price as I taken the screenshot. As you can see, this is in 2030, and it's not been caught yet, probably. So which means that there's still a price active on the bond. Full lot, I believe, just means that if you were to buy within this parameter, this is the bid and the ask price. So a bid and an ask just means that sell at a lower bid price and you buy from a higher asking price. As you can see, the bond price actually dropped from 99 issue price, which is very close to par, 100, and they have dropped to $83-ish. And you can see, so the bond price and the yield move in an inverse manner. So when the price drops, the yield will go up. So you can see the yield is 1.7 when it was issued, but now it rises to 4.9%-ish because of the drop in the bond price. Okay, Kenneth, let me ask you a question. Why do you think the bond price dropped? So from 99 to $83-ish, like, how come it dropped in price? And what does it mean for a bondholder? If you are a bondholder, you only care about you get this 1.65% coupon rate, right? 1.65 multiplied. Yeah, and at the end of the day, when maturity, you get back the principal. But what is this price? What is this, like? How do you interpret it? You want to take a guess?
I think for bonds, common people can trade it as well, right? So other than that, principal and interest rate, they may sell it anytime. They may trade with others, right? So depending on supply and demand, that price may fluctuate. So
correct.
Yeah. Okay.
So imagine you bought this bond when it was issued. You can always sell it. So if you were to buy this bond at 99, if you had to sell it, you'll be selling it at a loss. In the sense that, if you don't hold it to maturity, it is at a loss in terms of the bond price. But depending on when you sell, you have gotten some of the coupon. But in general, this price actually dropped. So you answered the part about why there's a price to it. But how about the lower price? Because this bond price could go up rather than going down. So why do you think this price actually went down?
It went down because it's closer to maturity.
Nope.
Nope.
The bond price, it actually doesn't matter when it's close to maturity or not. I mean, we're talking about plain vanilla bond, but this is a callable bond. But in this case, if we just treat it as a plain vanilla normal bond, it actually doesn't depend on the maturity. Okay, I'll give you a hint. It has something to do with interest rate.
So the interest rate actually went up.
Correct.
During this time, yeah.
Yes. So if Apple would to issue a new bond now, it will be issuing at a higher interest rate because market rate is now higher. So in order to compensate the buyer for the fact that because you see this bond is only paying you 1.65%, right? If Apple were to issue a new bond now, you'll be paying closer to 4 point something percent. It's probably between like 4.8, 4.9%. Let's say it'll be issued at 4.9. Who will want to buy your bond when Apple will be paying a 4.9% bond and you're only receiving 1.65? So the only way people will buy this bond is if you lower the price. In the future, we will show how you can calculate this price based on the maturity. But I mean, intuitively, you can understand that if the market is now paying a high interest rate and your bond is only paying a lower interest rate, it will just result in your price dropping, which is what we will call a discounted price.
But then, even if the price dropped, right, it's still not a good idea to buy this, right, versus another bond that pays the market interest rate.
Oh, it will be exactly the same.
Exactly the same.
Exactly the same. You will see later when we do the calculation. By paying a lower price, it's like you are getting a higher 4.9% interest rate.
That means the principal they're giving me is higher than what I bought it in.
No, the principal is the same.
Okay.
Even the coupon is the same. You're only getting 1.65, but you're paying a lower price for it. Just imagine initially you paid $100, like $99, but now you're only paying a discounted price, right?
So I can sell it back at the original principal price. Let's say I buy 10 shares. How do I call it? 10 bonds.
You can just multiply it by the notional. For example, you could buy like 1 million worth of bonds, or it could be like 100,000 or even like 2,000, right? So it just depends. So for example, 2,000 just means that 0.83 multiplied by 2,000. So that, I will just bring up the calculator. So okay, if it's par, right? If it's par, okay, let's just say $2,000. You want to buy $2,000 worth of bond.
Yeah.
If it's par, is 100. That means you will pay $2,000 and you get back $2,000.
Okay.
Right? And then you will get the interest from here.
Yeah.
And if it's 0.8, let's say 0.83 multiplied by $2,000, you will only pay $1,660, but you will get back $2,000.
Oh, okay, that makes sense.
Yeah.
So I'm getting it at a discount, I will get back the full principal.
Yes. So which is why at the end of the day, just paying a discounted price is equivalent to you getting a higher interest rate.
Hey, if that's the case, then Apple doesn't need to issue a new bond, right? It can just keep on changing. Like that price will actually reflect the market rate.
Okay. What Apple could do, they could actually buy back this bond at a lower price because now the interest rate is, because just imagine the market interest rate now is like, if I want to borrow the same amount of money, I have to pay a higher interest rate.
Yeah.
But now I really lock in a lower interest rate to the bondholder. Actually, this bond actually decrease in value. It's actually a good thing for the. So sorry, your question is,
should Apple buy back, and then should Apple issue a bond with higher interest rate? Maybe it doesn't need to. My argument is because it can keep on using this bond, right? Because
but this bond will mature, right? Once they borrow the money, remember, corporation and government, they will roll over the bonds.
Yeah. Okay.
Which means that if interest rate continue to stay high, eventually they will have to issue a bond at a higher interest rate.
Yeah.
So they will have to end up paying a higher interest rate. A lot of people is saying, hey, but why the Fed interest rate hike doesn't actually affect a lot of companies? It's because a lot of companies, for example, Apple, they have already locked in a low interest rate for say a 10-year, 20 or 30-year bond.
Yeah.
As long as they don't have to roll over or to issue new bonds, this higher interest rate doesn't actually affect them, right? Because they already locked in the rate. As long as by the time I issue a new bond, the Fed will have cut rates, it wouldn't actually affect them. And for big companies, they can issue like very long-term bonds. But for smaller companies, maybe they don't have that luxury, right? So a lot of this high interest rate affect the smaller companies more than the bigger companies.
Okay.
Because the
Yeah.
smaller companies, they will have to roll continuously and it will be affected by the Fed interest rate.
Okay,
Yeah.
as the lender, right? What should I be doing here? Because I lock in at I'm getting interest rate at 1.65, and the current interest rate is like 4.9, right? For example, and then what should
Just do nothing. If you don't need extra money,
Okay.
you just do nothing. Or if you want, you can just buy back the bond.
Okay.
You can buy it back at a discounted price. But in most cases, I believe they will just do nothing. Let me rephrase it. It depends on how they project what is the interest rate in the future, how much money they need for their day-to-day operation. So all these are factors that they will need to discuss about. Or they might think that the interest rate is going to get even higher in the future. So even though interest rate now is like high, I better issue more bonds now, right? Because just in case interest rate goes up to 10%. So in this case, there's really no reason for, you cannot really predict what's going to happen, right? So in order, the prudent way is to maybe have a ladder kind of way. I have some kind of schedule in how I issue my bond, like how they mature. And so all this is slightly more complicated that we will touch upon in the future.
Yeah.
But for a simple understanding, this is like how you think about it.
I have another question. Why would I buy a senior unsecured bond versus I just pick a senior secured bond?
So a senior secured bond will be safer, but it will give you a lower coupon interest rate.
Okay. So my only risk here is Apple suddenly go bankrupt, right?
Yeah, but if it's a secured bond, that means it's highly likely you'll get your money back.
Okay.
So if it's a secured bond, you'll get a slightly lower interest rate, because the thing is, Apple is a very big company. The chances of it going bankrupt is extremely low. So I believe that between secured and unsecured senior bond, the difference will not be huge. So for a lot of people, for some other companies which don't really worry so much about this particular counterparty risk, to them, senior, secure, unsecured doesn't really matter. So they might just take the unsecured bond and so they can receive a slightly higher interest rate. You see that a lot of these technology companies like Apple, Facebook, and others, because of the interest rate hike, right, it doesn't really affect them because, like I said, they already locked in a lower interest rate. And not only do they not affect them, it's actually a good thing for them. They are actually benefiting from the high interest rate. You know why?
I don't know.
Because they have a lot of cash.
Yeah. Oh yeah. They have a lot of cash.
They have a lot of cash, and these cash are actually earning them very short-term rates, right? They're actually earning them a lot of high interest rate. At the end of the day, the interest rate hike not only doesn't affect them, it's actually a good thing for them. But of course, if they were to roll over their bonds, it will be a bad thing for them. But at least for now, if I already locked in a low interest rate and I have plenty of cash with me, and I can earn a short-term interest rate at like 5%, this is like a dream come true. But this is for certain companies, it doesn't actually matter for for others. So in a sense, the Fed interest rate policy might have a very minimal impact for certain companies, or at least unforeseen situation now. But in the long run, if the interest rate continues to stay high or go higher, it will affect everybody. But at least as of now, it's like Apple, it doesn't really affect them. Okay, so before I move on to the next example, so this is a callable bond. Do you remember last week we talked about callable bonds, the contingency provision? So this bond can be called. So what this means that 5.7 years after 2020, right, it may redeem these 2030 notes at any time in whole or from time to time in part prior to the maturity at a redemption price equal to 100% of the principal amount. So basically, they will just buy back at par value of the 2030 notes being redeemed plus accrued and unpaid interest but excluding the date of redemption. So this is on or after 11 of February 2030. So this is, actually this part I'm actually not really very sure. Because this is 2020, 2030 is 10 years. But it means, but your next call is 5.7 years, so it should be 2025. I'm not sure why it says February the 11th, 2030, because this is pretty much very close to the maturity date. Yeah, we'll just move to the next example. I think we spent too much time on this, but this is another bond. This is a Chinese bond that is issued in the US, so it's denominated in USD. This is an example of a puttable bond. So the previous one was a callable bond. I just want to show an example that's a puttable bond. That means the bondholder can put back the bond to the issuer at a certain price. In this case, we can see this is at any time following the occurrence of a put event. So a put event we will see later down here. The holder of any bond will have the right at such holder's option to require the issuer to redeem all, but not some only of the holder's bond on the put settlement date at 101% of the principal amount. So this is like a premium. So I can pull it back. So you can see the price right now is 93-ish, right? But if a certain event happen, I can pull it back. I can sell back the bond back to the issuer at a higher price. In terms of it will be 101 price. So this is a way to prevent a certain event from happening. In this case, is the Mr. Wang Jianlin. It's easier to be on control of the company, and basically you can read it on your own. So this is like some of I'm just trying to show you one example of a puttable bond here. And this is a high yield corporate bond, unlike the other one, which is like this is a AA plus bond. It's not even rated. This is like pretty much a junk bond, which means that the interest rate is very high. See, like 7.34%. And this you can see it's issued at 7.25%, right? And this is like a 1.6. The reason why this is so high because this is a very risky bond. It's a high yield bond, and the same thing is because the interest rate actually went up, so the bond price actually went down. And the yield is so high, you can see it's like, wow, it's like 28% for a bond. Okay, so I want to contrast this with another thing is probably maybe you're interested, as you see the ISIN and the CUSIP number is very different, right? It's not like the Apple one, which has. So it doesn't necessarily mean the next 9 characters are actually the same as the CUSIP number. This is a government bond. So this is a US Treasury note. So in this case, it's no longer a corporate bond. This is a sovereign bond. It has a AA plus bond rating, which is the same bond rating as the Apple stock, which is like pretty much it's a AAA rating. And we can see that it's paying a 4.25%. Because this is a bond that's issued in 2024. Apple was issued in 2020, right? So as you can imagine, by now the interest rate has risen at 4.2%, which is why the yield is closer to above 4%, because interest rate has risen, and the government is like the base rate. So the government bond is like the lowest possible interest rate. So if government is paying 4.25%, that means that Apple will have to pay even higher than that. And similarly, you have issue size. Oh, imagine how much this is, like $71 billion the government is borrowing. You see, this is like a 30-year bond. This is like not a callable bond. So this years to maturity, it's just pretty much very close to the number of years difference here. Next call is invalid, which is why this is not a callable bond. This is just a plain vanilla bond. Okay. Oh, I also want to give an example of a perpetual bond. Remember, a perpetual bond is a bond that doesn't have a maturity. It goes on forever. So this AIA insurance company, so this is the it's issued in 2021. It doesn't have any maturity date because it's a perpetual bond. So they will pay 2.7% forever, right? And you can see a perpetual bond, you can always sell the bond. You can always sell it. So there's a price tied to it. The reason why this is below is also the same because interest rate has risen. And this is a coupon type is variable. So this this is not this is a fixed. I'm not sure why the coupon type is variable. Probably I need to check. But this is a fixed bond. Maybe it's variable in the sense because this is a callable bond. Actually, I can check it now. I'm gonna just ask ChatGPT. Wait. Why is okay, so other than that, okay, so this is wait, sorry. So this bond is a callable bond. You can actually the issuer at his own discretion can redeem all of the securities at par. Par means 100 on the first reset date. Oh, this is a wait. This is not actually a fixed coupon because there's a reset date. So there's a reference rate. Oh, see, this is a floating rate. So this is a okay. So what happened is okay. So this perpetual bond initially is fixed at 2.7%, but after 2026, it's going to be a floating rate bond. So the floating rate is based on the in the future after 2026, the 5-year US Treasury bond has an initial spread. Remember, I was telling you have a spread of 1.758%. So for example, if the 5-year US bond, Treasury bond is like 5%, then it'll be 6.758%. You always add a credit spread to the bond. And this is a callable bond because you can see this is a perpetual bond, which means that this bond is going to pay forever, but the issuer can always call it back. So it's not strictly going to run forever.